We are starting to see some cracks in the economy, which could easily lead to cracks in the markets. Change is on the horizon. But what do these changes mean for you? And how can you take advantage of a potential big opportunity if the markets turn to match the distress that we see in the economy? In this Business Insider article right here, which was written just 2 days ago on December 11th, it is a list of all the companies that are currently planning some cuts in their employment. Now, 180 jobs here, 1,000 jobs here, 2,000 jobs there. Not a big deal, right, Mo?
Right.
But when you have it across every company, and 2 or 3 years ago, we never heard about any layoffs.
It adds up quickly.
It adds up quickly, and it tells you, okay, like I look at Hasbro. Hasbro is cutting 1,100 jobs they just announced. That's on top of the 800 they already did. That's a big chunk of their employees. Now, what does Hasbro do? They make toys. So I'm looking at saying, okay, they make toys, which the average American buys. If they see a slow enough demand for their toys, what does it say about the consumer? Right? Yeah. If they have to go lay off people, that tells me, and by the way, Hasbro's done this in the past. There have been ups and downs in the economy. And again, I'm not trying to be a fudster here. Mo isn't either. What we're trying to do is make sure everybody disconnects the economy from the stock market. The stock market's going to react to what happens in the economy. Go look at every time in the past stocks fall and stocks go up. They're a reaction to what people perceive at the moment, right? So right now, what do we see? We see higher interest rates from a year and a half ago. Much higher. And yet we don't see the fall that we would have thought in stocks.
Yeah.
Why? I really honestly don't know why.
I don't know why either.
It's amazing to me. But then we start seeing companies starting to cut employees.
Here's Spotify. Spotify's cutting 1,500 jobs. That's 17% of their workforce.
Yeah, and the Hasbro was 20%. Yeah. Right here, Citigroup, hundreds of jobs. Not a big number for Citigroup. Amazon, 180 in its gaming division. Again, Amazon's got 10 trillion employees. 180 is not a big deal. But years ago, they weren't even cutting anything. That's the interesting part. Charles Schwab, a broker of brokers right here, 5 to 6% of its staff. I look at that saying, okay, what is going on here? There are things like this where I sit there and say, like, I don't even know some of these ones. Flexport, logistics, laying off 30% of its employees.
If I'm not mistaken, did Meta and Google lay some people off earlier this year?
Wasn't it last year? And then
was it end of 2022?
Something like that. Okay. But remember, back then, stocks had taken a big fall.
Yes. Yep.
And you look at even a guy like Howard Marks. He wrote exactly a year ago about this change in the economy and how he looked at what people perceived to be for the economy. Of all the things he's writing about here, the only two that have changed are likelihood of distress, mood, and buyers.
Yeah.
Because I look at this saying, but guess what? It was written after the market had fallen over 20% and tech had fallen 30-some%.
Right. This was December 13th, 2022.
A year ago exactly today. By the way, happy birthday, Taylor Swift. So we sit here and look at this and say, okay, what does this mean? Well, I just have to answer it and say, when you look at a big piece of the economy, which is housing, right? Housing is very tight right now. Why? Because interest rates have skyrocketed.
No inventory. Not
much inventory. Home building is at big time lows. You see a big jump in apartment buildings being built because people are saying, hey, we don't know if people are going to be able to afford buying more homes. Right now, home buying is at the highest level relative to renting than it's ever been. Wow. It's like 52% more expensive to own a home than to rent a home.
Wow.
So it tells me one of two things. Either rents have got to jump up to keep up, or home prices have got to taper. I'm not saying fall. And I said that 2 years ago when they started raising rates. I said, listen, guys, I'm not thoroughly convinced that raising rates in and of itself is going to lead to lower home prices. If inflation stays up, it drives up the cost of building homes, therefore drives up the cost of renovating, and therefore drives up the cost of replacement of a home, then home prices can still go up. And it's done that. Now, guys, stay in this video because there is something you can do to factor all of these in that I'll get into a little bit later. Now, if you've watched our past videos, we agree 100% with Howard Marks when he explains the refinancing of debt. Guys, typically, a company will have debt for 5 or 6 years at a time. So they'll borrow today, lock in for 5 years, and 5 years from now, they'll refinance. As Howard Marks says, which I think he's 100% right on, companies do not pay off their debt. Right? Yeah. We talk about that.
Look at every balance sheet we look at.
Yeah, they grow.
Yep.
Right? The balance sheet debt side tends to grow. That's fine. But here's where there's an issue, and this is where I think Howard Marks is talking about when he talks about these zombie companies that will go out of business. Let's say you're a company that has $800 million in debt and you were paying 4% interest, okay? You're paying $32 million a year on interest charges. Very simply, right? Great. Fast forward 5 years, interest rates have gone up to 8%. Now, if you're able to keep the same $800 million in debt, you're already immediately jumping your interest costs. Sorry, $64 million each year. You're doubling it, right? But here's the other issue. If your interest rate increases, a bank's going to give you less debt. They're going to factor it based on your profit. So let's say there is a slight recession or just stagnation for a while. What happens when your profit is the same, but your interest cost doubles? The bank's going to say, listen, we can't afford to give you that much debt. Now we're going to give you $400 million in debt. So what do you have to do? If you're going from $800 million in debt to $400 million, what do you have to come up with?
Generate a lot more profit.
Or write a big check.
Yeah.
You have to write that big check here. That's what he's talking about here. Just like your house. Let's say, for example, you borrowed on your house for 5 years at 3%, and your income stays stagnant for 5 years, and all of a sudden your interest rate doubles. Are you going to be able to, one, afford the new payment, or two, even justify the new payment where the bank will give you enough? They're going to factor on your income. Now, it's optimistic to say, oh, their profit will go up, companies will go up. Sure, but we haven't had a recession in how long? I don't even consider COVID a recession. No. When he talks about this, it's exactly spot on. The fact is, you have this big jump in interest. And this is a hypothetical example. This doesn't say it's going to happen. Companies like Microsoft, Google, those guys, it's not going to be a problem for them. But we talk about smaller companies or companies with look at AT&T. We always talk about AT&T.
AT&T, Verizon, T-Mobile.
They have huge amounts of debt. So what's going to happen when those debts start to get refinanced?
It's going to be trouble.
It could very well be trouble unless they're able to really increase their profit.
It's true.
Or raise some equity to pay down that debt.
Yeah.
But either way, is that the position they want to be in? He believes that 10% of publicly traded companies could go to zero or go out of business or be acquired or something to that level. That's a pretty big number. 10% of publicly traded businesses. But guys, remember, that's a good thing. We don't want every single company in the world to be successful. We want the crappy ones, the ones that didn't manage their balance sheets the right way, to go to the wayside. We want to give more business to the smarter companies and the smarter management teams out there.
Yep. Part of the reason that we want recessions is to kind of get rid of the bottom feeders.
It's a cleansing of things, correct? So that's what he's talking about, and we 100% agree with him. Even though we agree with a lot of the fears of a bubble bursting in a recession, we're here to offer a contrarian solution to the problem. This could be a huge opportunity for you as an investor. Don't view it as a bad thing. View it as the economy goes through things. They're going to have recessions, and we've always come out of recessions and even the Great Depression stronger, healthier, happier, wealthier. The great thing about high interest rates, there are more options for investing. You've got T-bills, 90-day treasury bills paying 5.4%. You've got 10-year treasuries paying 4.2%. You have money market accounts paying much better. Just 2 years ago, a 90-day treasury paid essentially 0% interest. That's what caused the markets to go up so much. Because of this, the hope is that asset prices decrease or valuations get better that allow you to put more money into better valued markets like the S&P 500 or into great companies at good prices. That is the whole key to what we talk about here. Value investing is about paying less than what you're buying. So, what happens if the market does crash like so many people think? And I've said this before too. The higher and higher we go, the more overvalued we are, the more likely we are to have a crash. And it's very simple. Everybody out there would say, well, I'd buy more, right? Absolutely. But here is what the tricky part is. It's easy to say I'm going to buy more. But if or when a crash does happen, the outlook has changed. So even though you say buy more, there will be the stories then that say, wait a second. The difference is now, the reason I can't buy is there's so much uncertainty. There's fear about this. That's what causes crashes. So when I hear the average person say, I just buy more, right? It makes me laugh because it's easy to say that now, but when it happens, the story in the markets and the economy will be very, very different. That's exactly why crashes occur, because people don't expect those things to actually happen. The things we couldn't imagine, the bad stories we can't even imagine about the future actually then will appear in the media. Right, Mo?
Yeah, absolutely.
Look at COVID. What did we hear during COVID?
The world was over.
The world's shutting down. The world's over. We're not going to have, we don't know when we're going to reopen. Economies are going to...
Businesses are just going to stop.
Yeah. And a lot of businesses did stop. And guess what? Are we better now than we were back then? GDP is higher. If you want to claim the stock market being higher is better, awesome. The stock market is almost, I think I got 40% higher than its pre-COVID peak. Guys, things will get better. It might take longer because the COVID crash is only 30 or 40 days.
Yep.
It might take longer this next go around. We have no idea. The point is, I look at history and I'm going to pull up the S&P 500 ETF SPY. Guys, 2000 tech bubble. Look, the world looked terrible right here. Financial crisis, the world looked terrible right here. COVID, the world looked terrible right here. Looked bad here too, just last year. Guys, guess what happened every single time? And the further and further you go out, the closer and closer to the 1930s you go, even 1870, all back then, we got through every recession. We got through every depression. We became better because of it. And you would have wished that you bought here, here, here. And some of you might think, I'm glad I bought here. Maybe so. I personally believe we're going to go through these lows because valuations are just a lot too high. That's not even the right way of saying it.
No.
But I look at the NASDAQ 100 selling for 35 times free cash flow. That is making, during good times, that's when people have the most optimistic of assumptions and the less likelihood that things are bad. Look at the VIX, which is the volatility index. It is at 52-week lows. And I saw an article the other day that said that proves the bull market's here to stay. And I was like, oh, okay, maybe so. But when people don't fear anything, that's when the slightest thing that interferes with you let your guard down. When you don't fear anything, it means you're not seeing the thing. You're not seeing the spark in the room that can cause the explosion.
Right.
That's the part that we're not telling you, run for the hills. It's just be ready for less returns for the foreseeable future. Not forever, but maybe the next few years, the next 5 or 10, they'll be better. What was that?
Last couple of years, the S&P is flat.
For the last 27, 28 months, the S&P is flat.
Yeah.
Think about that.
You wouldn't think it, but it is.
It hasn't. I remember when I first saw that on Twitter, I said, there's no way. And I went and looked at it like, oh my gosh.
And if you look at this year, without the last couple of weeks, we were not doing very well with returns outside of the Magnificent Seven. Things have changed in the last couple of weeks, but to basically the beginning of December, nothing was really moving.
And guess what? The NASDAQ is up almost now 18% since October 26th. Guys, it is December 13th currently. We're talking about 6 or 7 weeks ago. The NASDAQ 100 is up 17 or 18%. I don't know. Maybe again.
The tech valuations get 17% better in the last few weeks.
Yes, correct. These are the things that I think about. Now, what's the solution to this? What's the way you take advantage of all of this? Very simple, guys. Sit here and realize that bad times don't last forever and good times don't last forever. It doesn't mean stop investing. It just means prepare yourself for harder returns in the future. And when those do happen, as long as you're dollar cost averaging and buying not only your ETFs, but if you have individual stocks with good fundamentals and good balance sheets, you should continue to buy them on the way down. Of course, they're going to lose profit, cash flow along the way, decrease their profit and cash flow. That's okay. If you buy them for the right valuation based on a long-term approach of their profit and cash flow, you'll probably do very well when you buy them on the way down. That's why it is so much better to buy a S&P 500 ETF like SPY or VOO. Because at that point, you don't have to worry about which individual company is doing. Heck, if you really have balls, you know what you should do? As the S&P falls, little by little, increase how much you buy as time goes on. Add more money as stocks are lower. It will be scary. It will feel scary. But good news is, you follow this channel, and we'll be here telling you this is awesome, guys. And guess what? People then will tell me the exact same thing they're telling me today. Paul, you don't get it. Right now they're saying, Paul, you don't get it. These companies are great. These companies are awesome. Yet the ones we warned you about 2 years ago are literally bankrupt now. And I remember in 2008, people telling me, Paul, but you don't get it. Banks aren't lending money anymore. The world, okay, sounds good. During the COVID crash, Paul, you don't get it. The world is shutting down. Okay, sounds good. And I've been the guy who's been saying, I don't believe this whole work from home thing is the future forever. Absolutely, I don't believe that. I've been saying it since middle of 2020. I said, yes, it's the fad right now. But I also believe people want to leave their homes to go to work. I don't believe people want to stay home to work. They want to go to work. And I believe bosses want the face time and the camaraderie in their community. So right now, unfortunately, officers are taking a hit that way. But it's just in my opinion, a temporary problem that we will get around. And you have to remember that if stocks fall big time, we will get through it. Now, the most overvalued stocks are likely to fall the most, right, Mo?
Absolutely.
You look at a company like NVIDIA, up 400% this year. And the last 2 quarters, they absolutely demolished expectations. And yet the stock is not down a lot, but down about 5 or 6% from that all-time high. How does that make sense?
After just bringing in about $11 billion more in revenue than the previous quarter. And
huge gross margins and huge profit margins. Yeah. But all of a sudden, the other day, AMD announces a chip, and the stock falls. Is that the kind of company we want?
Realistic.
It's just, the market is not efficient. You have to be ready to jump on things when the right time occurs, and that's why we made this channel. Guys, remember, no one can predict the future. It is impossible. All we're trying to do here is teach a process that allows you to make better decisions that over the long run will do much better. Watch our next video on buying ETFs versus individual stocks.